My name is Orkotanu Chakraborty and today I am going to explain provision and reserves. In this slide I will explain what is a provision. A provision is an amount that you put in aside in your accounts to cover a future liability. A provision is not a form of saving, even though it is an amount that is put aside for a future plausible cost or obligation. A provision should not be understood as a form of saving. Instead, it is a recognition of an upcoming liability in advance. Now, in this slide, I will explain the types of provision in accounting. The types of provision in accounting are provision for bad debts, provision for taxation, provision for discount on debtors, provision for repairs and renewals. Now, in this slide, I will explain the types of provision in accounting in detail. Number 1. Bad debt provision. The bad debt provision is reserve made to show the estimated percentage of total bad and doubtful debts that needed to be written off in the next year, and it is simply a loss because it is not charged to profit and loss account of the company in the name of provision. Provision for taxation. A provision for income taxes is estimated amount that a business or individual taxpayer expects to pay in income taxes for the current year. The amount of this provision is derived by adjusting reported net income of a business with variety of permanent differences and temporary differences. Third type, provision for discount on debtors. In accounting terms, the provision for discount on debtors shows the reserve amount for adjusting loss due to discount allowed to the debtors. In order to receive payment faster from customers, businessman provides a discount to those customers who pay before maturity of the debt. So at the end of the year, we have to make provision for the next year losses due to discount allowed. Thus, provision will be known as provision for discount on debtors. The last provision, provision for repairs and renewals. In order to ensure a smooth measurement of income, many business establishments create a special reserve called provision for repairs and renewals, known as repairs and renewals reserves. The purpose is to ensure uniform charge against revenues until the useful life of the assets. Now, in this slide, I will explain the objectives of provision. Some of the important objectives of provision of maintaining provisions are as follows: to meet anticipated loss and liabilities, to meet known losses and liabilities, to present correct financial statements. Let me explain in detail. To meet anticipated loss and liabilities, provisions are created for meeting anticipated loss and liabilities such as provision for doubtful debts, provision for discount on debtors, provision for taxation. To meet known losses and liabilities, provisions are created for meeting known losses and liabilities such as provision for repairs and renewals. To present correct financial statements. In order to present correct financial statements and to report true profit and financial position, the business must maintain provision for known liabilities and losses. Now, what is reserve? A reserve is a retained earnings secured by a company to strengthen a company's financial position, clear debts and credits, buy fixed assets, company expansion, legal requirements, and other plans. These are usually done to save the cash from being used in other purposes. Reserve funds do not have any legal restrictions so that the company can use it for any purpose. Now, in this slide, I will explain types of reserves. Reserves are of two types: revenue reserves, capital reserves. Revenue reserves are again subdivided into two types: general reserves, specific reserves. Now, I will explain the types of reserves in detail. Revenue reserve is a proportion of profit owned by the company and is kept aside for the use of other multiple purposes. A capital reserve is taken out of capital profit and is not shared as a dividend to the shareholders. This reserve cannot be created out of the profit earned from the core operation. Now, revenue reserve, again in the previous slide I said it is divided into two categories: general reserve, special reserve. General reserve, it is a saving out of the profit share. The only purpose of this reserve is to strengthen the financial position of the company or can be used for many other reasons. Special reserve, this reserve is secured for a particular purpose and the money cannot be used for any other reason. Now in this slide I will explain the comparison between reserve and provision. The comparison between reserve and provision are as follows. Coming to the first difference, the definition. The definition I have said earlier. Next point, method of creation. The method of creation of reserve is, it is created by debiting profit and loss appropriation account. Provision, created by debiting profit and loss account. Purpose, that is the basis of comparison. Reserve, it provides capital for running the business and safeguards against the expenses from unforeseen contingencies. Provision, it secures business from expenses arising from known liabilities. Basis of comparison is allocation. Reserve, presence of profit is required for allocation of reserve. Provision, presence of profit not necessary for allocation. Next basis of comparison is payment of dividend. Reserve, paid from reserves. Provision, cannot be paid. Next basis of comparison is impact on profit. Reserve, reduces net profit of the organization. Provision, reduces profit for dividend distribution. Reserve, appears in, that is always shown on the liability side. Provision, in case of an asset it appears as a deduction of the concerned asset. In case of liabilities it is shown on the liabilities side. Utilization, reserve can be utilized for any given purpose. Provision needs to be used for the specific purposes it is allocated for. Thank you.